The market approach to valuation is a widely used method in apartment investing that assesses property value based on the current market and comparable property sales. By evaluating similar properties in the area, investors gain insight into a property's market value based on location, condition, and income potential. Two key methods under the market approach are the comparable sales method and the gross rent multiplier, GRM. Both approaches provide straightforward ways to estimate property value and make data-driven investment decisions. Key concepts in the market approach to valuation: comparable sales method, purpose and process. This method estimates property value by comparing the subject property to recently sold similar properties in the same area. Investors analyze comparable properties, comps, with similar characteristics such as size, unit count, amenities, and condition to gauge market value. Identifying comparable properties. Choose properties that closely match the subject property in size, age, location, and features. Adjustments may be made to account for differences in unit mix, amenities, or property condition. Analyzing recent sales data review. Sales data from the past 6 to 12 months for comparable properties focusing on average price per unit or price per square foot. This comparison gives insight into current market value and local price trends. For instance, if 3 similar properties recently sold for $1,200,000, $1,250,000, and $1,275,000, the investor could estimate the subject property's value within that range, adjusting for any differences. The gross rent multiplier, or GRM, is a valuation metric that estimates property value based on its gross rental income. By dividing the property's sales price by its gross annual rental income, investors calculate the GRM, which can then be applied to estimate value for similar properties. Calculating GRM. GRM is calculated by dividing the sales price by the property's gross annual rental income. A lower GRM generally indicates a better value, while a higher GRM may suggest a property is overvalued or in a high-demand area. Estimating property value with GRM. To estimate a property's value using GRM, multiply its gross rental income by the average GRM derived from comparable properties. For example, if comparable properties have an average GRM of 8, and the subject property's gross rental income is $150,000, its estimated value would be property value equals gross income times GRM, which is $150,000 times 8, equaling $1,200,000. Example: valuing a multifamily property, using the comparable sales method. Suppose a multifamily property is located in an area where 3 similar properties recently sold for $200,000 per unit, $210,000 per unit, and $205,000 per unit. For a property with 10 units, the estimated value could be calculated around $2,050,000, depending on adjustments for specific property features.